The analysis is very important. 5 marks for analysis. So we have to talk. Remember, the total mark for this question is 8. But see, all the calculations you've done is just 3 marks. The discussion is 5 marks. That is your financial analysis. So now, we've done the ratios to assess the performance, all of that, but we now need to talk, which means we need to interpret our ratios. And that is what we want to discuss right now. Like I said, it is not enough to calculate, but it's even more important to be able to analyze. And I gave you a structure to it. I said, first of all, calculate. So now we have calculated. So we've done the calculation. Yeah. So the next step is what can you see, then why. So for each of the ratios we want to discuss now, we need to talk about what we can see. So we'll use these 3 guys as our financial performance discussion. So we'll use this one for financial performance. Remember, profitability is about performance, and risk as well. We'll just talk about it as I to talk about they are doing. Then TSR and EPS, we'll talk about it as part of the question because that was specifically asked. So let's start with ROCE and see the way I'm going to talk about them, right? So I'll look at this ROCE. I've done the calculation of ROCE. Then what can I see? What can I see about ROCE? I can see that ROCE has been increasing. So I will say ROCE of JJG has been increasing from 2005 at 22% to 25% in 2008. Now I want to talk about benchmark. So I've talked about the trend. I want to talk about benchmark. In 2008, the ROCE of JJG is the same as the sector, which is good for the company. You see? Now, I've not only said what I saw, I said it's increasing. But you see that I've interpreted whether it's good or whether it's bad, because I've compared with the sector and I can conclude that it is good. But the question is, I can't end there. I also need to say something about possible why. So I will now say, remember, don't be categorically writing a statement as if you are the owner of the company. Use the word might all the time. So I'll see the way I'm going to write it. I'll say, this might. See, might. I'm using that word. So this might be due to an improved or more efficient. Any word you can use more efficient or you can use improved. So more efficient use of capital. Yeah. And I'm saying this because when I look at the formula is PBIT over capital employed. So if this ratio is increasing, it's that you are using this very well. And when you're using it very well, it means that from the little amount of capital, you are getting improved profit. And that means you are more efficient. Yeah, and that is ROCE. The same thing I'm going to do for ROE. The same trend, yeah? This time around, I'm not going to write it in full. Now you can see the structure. Yeah, so what I'm going to say, I'm just going to say it, and I'll say, let's look at ROE. What has happened to ROE? Look at our ROE. It was 34, 31, 29, 28. So it's decreasing. So this time around, I will say ROE has been decreasing from 2005 to 2008. That's what I can see, right? And compared to benchmark, what is the benchmark for ROE? 20%. So all the years, they achieve more than the industry sector. So I would say that. So I would say throughout the period, JJG has always outperformed the sector. And what does that mean? That is good. So you have to say it, which is good for the company. Yeah? But the question is, why is ROA declining when margin ROCE is going up? Why? So you have to say something. Can't keep quiet. So when you look at both formula, this is ROCE versus ROE, which is PAT over equity. This is decreasing. Why this is going up? Why? So you need to say something. You can't keep quiet. So what you can see possibly is PAT must have been declining most likely. But let's look at PAT. PAT has actually been increasing. You can see it's increasing. PBIT is also increasing. So why is ROE now coming down? If this is going up, this is going up. And the same equity you have here is the same equity you have here. What you can say, you cannot say it categorically, but what you probably see is a possibility that the interest, because the difference between PBIT and PAT is interest and taxes. So the possibility is that the interest is so much that though the PAT is increasing, but it's not increasing at a rate that is big enough to cover up for the debt that is being used by the company. So, which means you need to say, because you can't keep quiet, say this might be due to interest expense on debt that is gradually eroding earnings. Therefore, you can now even say it clearly that profit after tax, which is your earnings, might not be increasing at a sufficient rate. Please don't use this in exam, write it in full. But I'm just trying to short it so that you can save time at a sufficient rate. Right. And you have said something. Always say something why. And that's ROE. So with that, with ROE, remember I told you you must touch everything in the benchmark. Now, debt equity ratio. What can you see? Debt equity ratio 136, 108, 63, 42. Benchmark 50. So that has also been decreasing. So debt equity ratio. So you say, what can you see? It is decreasing over the years. And in 2008, it is less than this benchmark sector. Yeah? And what does that mean? If risk is lower than the benchmark, that is good. So you conclude like that. So we've said three things. 1, 2, 3. Then the last thing is possible why. Possible why. And it's very easy. Why is debt equity ratio going down? Debt equity ratio. This ratio is going down and will only go down either debt is going down or equity is going up. So let's look at the market value of this, both debt and equity. We'll see what will be the right explanation. This is the two guys that we need, equity and debt. Look at debt, it's constant. Nothing has happened to it. But what happens to equity? Equity has been going up. You can see. From 14 to 18 to 31 to 47. So which means this is not our explanation, but this is our explanation. So that's what we're doing. So we now say this might be due to, in fact, for this one, you can see it's clearly sure. You can see that, so you might not even use the word might here, because you can be arrogant with this one. You can see it. There's only two things involved. So you can say this is due. Yeah, so this is due to increase in market value of equity over the years. And the question is, why would the market value of equity be going up over the years? You can't also keep quiet. Yeah, it means that the investors are seeing the company as a good company, maybe because it's doing well. And why is it doing well? It's been making good profit. So you can say that. So to say, yeah, that increase in market value of equity might be due to positive perception of the investors due to consistent increase in profit. Let's look at the financial statement. Yeah. Look at the profits been going up, earnings has been going up, even sales has been going up. So you can just chip that in there. So increase in profit and sales. There's no way you will not get a maximum score for this. Right. Now, so we've dealt with the initial part of the question, which is talking about the financial performance. Yeah. Now, we want to also speak about how have they been able to maximize shareholders' wealth and achieving continuous growth in EPS. We have to touch that as well. So let's talk about TSR. Yeah. So remember, the overall indication of how you have maximized your shareholders' wealth is your TSR, total shareholders' return, because this touches both dividend, which shareholder want, and also the price gain, which those are the only two ways any shareholders can make money, right? So what's our TSR? Let's look at our TSR. We've calculated it already. This is it, 57, 81, 36. So it increased from 36 to 81, then decreased to 57. So you can speak about it. Yeah, that TSR increased in 2007, but decreased in 2008. However, remember, when you compare it with the benchmark, JJG has always outperformed the sector with required return, because the required return in the sector is 14%. So JJG has never had anything less than 14%. So, which is good for the company. I must say that it's good for the company. Yeah. And what is the possible why? Because similar to what we said here, the possible why is because there are good perception of the company by the investors. They believe that the company is doing well, so the price of the share keeps going up. So they are getting benefit here. And also because the company is making profit, they are able to pay dividend. So you now need to conclude, because the question says you should talk whether they've been able to achieve it. So as achieve is stated objective max. So have they achieved the objective of maximizing shareholders? Well, you have to say it. So JJG has been able to maximize the shareholders' wealth. Yes. Using TSR. Clear. You've achieved that. Now, the next part of the question, which is part 2, is EPS. Let's look at EPS. We've calculated it. the objective is to keep growing EPS. Have they been growing their EPS from 65 cents to 75 to 85 to 100? So actually, they've done very well. They've been growing. In fact, this one talking about growth, you can even calculate the percentage growth so that we can put it in our analysis. It's very good. So let's calculate the percentage growth so that it makes our analysis to be very robust. So we can do, so this will equals to this minus this. Remember, percentage change is new minus old divided by old. Yeah, so, and we're going to do the same thing for as much as we can get. We can only get for 3 years. Yeah. And we can even do average. So we get the average growth. %. Right, so very good. So can I talk about it? That the EPS JJG has grown its EPS consistently at an average rate of 15%. Yeah? Why? Obviously, earnings per share is earnings divided by number of shares. Number of shares has not increased. It has not changed, as we can see. It's 5.5. But what has gone up? Earnings has been going up. So that is the reason why earnings per share has been growing. So, which is the reason we'll put there. This is due to good earnings performance. Yeah, that is it. And this is good for the company. Yeah, it's a good performance, so it's good. I have to say it. Don't say it's obvious. Say it. It's a mark. Then in conclusion, because that's what they ask you to check, whether they've been achieving their objective. So in conclusion, so I'll say overall, JJG has been able to achieve its objective of maximizing shareholders' wealth and growing its EPS. And that is the end of that question part A. We've dealt with this. Now, the B part. Yeah, so the section B of the question is asking or says, if the new finance is raised via the right issue of 7.5 per share, which means the right price will be $7.5 per share. Yeah, by one right share. And the major expansion had not yet begun. Calculate and comment on the following effect on the right issue. So the first effect is on the right on the share price, which means they're asking us, after the right issue, what is likely going to be the share price? And that is a theoretical extract price, which I've taught you how to do before. Remember the structure I always tell you, put both old and the new. And so you have old and the price, and you have the new and the price. Right? So currently we have 5.5 million shares, and the price is $8.64 per share, And the new that we want to issue now, we don't know how many shares are we trying to issue. And the right price is going to be 7.5. So we need to quickly get this, to be able to calculate the theoretical extra price. Remember, we want to raise $15 million in total at $7.5 per share. So which means we are saying $7.5 is for one share that we want to issue. So if we are to raise $15 million, how many shares do we need to issue? That will be 15 times 1 divided by 7.5. And that equals to 2 million shares. So which means the new we're talking about here is 2 million shares. Right? So to put it now, I write it here. So 5.5 is to 8.64. And 2 million shares to let me call it at. So at $7.5. So which means this will be 5.5 times 8.64. That will be 47.52. And 2 times 7.5 will be $15. So the total number of shares is 7.5. And the total value will now be 62.52. And in that case, this 62.52 is for 7.5 shares, but we need the 1 for 1 share. That's theoretical extra price. So the theoretical extra price will now be 62.52 divided by 7.5. And that will give us a theoretical extra price of $8.34. So that is the effect on the share price. The share price will reduce from what it used to be. It was in 2008, it was 8.64. So from 8.64 to about 8.34. Yeah. So that's the impact. The next one is impact on earnings per share, EPS. Remember, the formula for EPS is profit after tax divided by a number of ordinary shares. Yeah. So the question is, because we have issued right, does it mean we have different earnings? No, because the question says the expansion has not even begun. So there won't be impact on earnings for now. So our earnings will remain 5.5. However, the total number of shares will change. Before we had 5.5 shares, but now we are raising another 2 million shares. So that will be a total number of shares. So if you have 5.5 divided by 7.5, and that will give us 0.73 EPS. So you have 0.73 earnings per share. So which means, what's the impact? Let's see, what was the earnings per share in 2008? This earnings per share line from 1. So earnings per share has reduced. So likewise, reduction from 1 to $0.73. That's the impact. The third one is on debt equity ratio. Remember, the debt equity ratio has always been in market value basis. So even this question did not say it categorically, but please, because remember I told you, whatever you have as a benchmark will be your guide as to how you will deal with it and be consistent. So we're going to calculate that equity ratio for the current situation now, and we'll see what that means. So for debt has not changed. So which means our debt will remain 20, but equity will be different because equity number of shares has changed. Now we have 7.5 shares. Remember, 5.5 and the 2 new right issue shares. So we have 7.5 shares times. Then after the issue, the best estimate of price is the theoretical extra price, which is 8.34. So 7.5 multiplied by 8.34. And that is 62.55. So debt equity ratio at market value will now be 20 divided by 62.55, and that will give us 32%. Yeah, so in 2008, we had debt equity ratio at market value at 42%. But with this right issue, we have been able to reduce our gearing even further. So gearing also reduced from 42% to 32%. So those are the impacts, and you've been able to get your 6 marks easy from B. Now, C wants us to analyze and discuss the relative merits of right issue, placing, and bond. So there are 3 sources of capital there that they want us to analyze there, right? So because it said analyze and discuss, I will not advise that you only talk about the advantage, which is the merit, but you should also give a bit of introduction, which is about talking about the meaning of each of that. So for right, very straightforward. What are right issues? Right issues are sale of shares to existing shareholders. Yeah, sell to existing shareholders in their proportion of ownership percentage. Existing ownership percentage, right? So if they have 10, 20, 30, you share it based on 10, 20, 30 like that. And what are the merits? The first one is the fact that it's definitely cheaper to issue. Yeah, because you don't need to get all the brochure, you don't need to get so many consultants. Yeah, you just passing a motion or a proposal. Management will make proposal to the board and to the shareholders, and once they pass it, they know that okay, yeah, we have this board steer to share. Shareholders approval as well been there to issue new shares for the existing shareholders. So that will just be sent almost like notification, and everybody that is interested will buy. So there's not so much to incur in trying to achieve that. Very important. So it's cheaper to issue. Likewise, it will reduce gearing because equity is going up. Remember, the denominator, because gearing is debt over equity. So when this goes up, the whole gearing will reduce. Likewise, prevent dilution of ownership because the new shares will be issued at the existing ownership percentage. So they will still retain their ownership percentage, so there's no dilution. And likewise, the success rate is typically high because the shares are sold at a rate that is at a price that is cheaper than market price. So mostly shareholders will have to take it. But how is this different from placement? Placement is sale of shares to selected institutional investors. Let me use the word selected, because not just anybody will be able to buy this one. There are some selected institutional investors, financial companies. Institutional investors. Just trying to squeeze that in there. Write it. Let me know, assume that you can see it, so I'll write it again. Let me squeeze it back. Institutional. Usually banks. Yeah, selected institutional investors who will buy the shares. Yeah, and what are the advantages? Yeah, likewise, it's cheaper to issue because you are not giving to the whole public. Yeah, so maybe it's slightly expensive than right, but it's cheaper to issue when you compare to your normal public offering. Yeah, that is available to everybody. Another benefit for this is that this goes beyond the existing shareholders. Yeah, you have access to wider base of investors. So there's access to wider base of investors. So you probably get more money. That's what we're saying there. Yeah, and because it's still equity, you expect it to reduce gearing. So gearing reduction is part of the merit. Yeah, very important. And that's it for placement. And for bond, what are bonds? Bond is just a sale of debt to investors. Yeah, whoever wants to buy. Yeah, but this happens on the regulated market, not just on the street. Yeah, so when you have a sale of debt, somebody wants money and is giving people paper that is owing them and collecting cash from them. Yeah, that's bond, but it's regulated, not just for anybody. So when you have sale of debt to investors on, remember, regulated market, that's bond. And the best advantage of using bond as source of capital, like we did, if you remember when we're looking at cost of capital, is the fact that cost of debt is cheaper than cost of equity. Yeah, so overall cost to the company is cheaper. So cost of debt is cheaper than equity. Remember, we're not talking of cost to issue now. We're talking of the interest expense versus the dividend and other things that shareholders will be asking for shares. So generally speaking, cost of debt is cheaper than cost of equity. Another benefit is the fact that there's a tax benefit on the interest expense if you decide to issue debt. So there's tax benefit on interest expense. And that is it with JJG question. Yeah.